computer. Okay. So, hello everybody, and thank you for being here today with us and this new meeting of the Finance Online Seminars. And today, our guest is Taylor Spears from University of Edinburgh. And the talk of Taylor will be when models become market infrastructure. So we have a talk about a very hot topic in finance, I mean, in the market, and I mean the role of models. And in particular, Taylor will talk about the ontological and material alignments of models. And okay, yes, that's all from me. And I pass the word to Taylor, and I thank very much him for being here today and for accepting our invitation. Thank you, Taylor.
Thank you very much, Emiliano. Yeah, and it's a real pleasure to be here. This is based on a project that I began a number of years ago as a PhD student, and I, kind of had to move away from for a number of years and work on other projects. But I'm very keen to kind of get feedback from the attendees, because this is one of these topics that very much delves into matters of philosophy. I'm not a philosopher by training, and so I'm very kind of keen to get feedback on this. Obviously, the philosophical literature on modeling has influenced a lot of my thinking on this, though. So one of the things that we see across a number of different literatures in philosophy, STS, in the work that I do in the social studies of finance, is this question of how models, whether they be economic models, financial models, or even other forms of modeling more broadly, such as machine learning, how these entities change as they travel across field and disciplinary boundaries. I know that in the philosophy literature, there's been this distinction made between model migration and model imperialism. I think this is a very useful concept that, and this has inspired some of our thinking in this piece. And what some of this work points out is that in some cases, models, as they kind of move across disciplinary or field boundaries, they're modified and kind of imbued with new forms of representational power. But in other cases, the models themselves really don't change very much. And instead, their kind of accepted domain of application is expanded. So normally when we talk about kind of the economic imperialism, it would be this latter case. And I think this question has a lot of practical relevance. It's obviously a very intellectually interesting question, but I think it also has a lot of practical relevance, given some of the work that we're seeing in fields such as sociology and in accounting on that really kind of speculates that the diffusion of economic models and financial models into new domains may be, say, a contributor of financialization, which is something that Eve Chiapello and her colleagues have written on. And as Emiliano and I were talking before I began this talk, it obviously speaks to these old questions about the degree to which economic models can be performative. Now, we have quite a bit of work that's been done already on modeling, and we know from this work that models change through a process of bricolage. That's usually how this kind of change is characterized, but it's not a sort of random form of bricolage. It's usually a kind of directed process. And we can see this, for example, in Donald Mackenzie's old work on the historical development of the Black-Scholes model. He argues that a process of bricolage was at work that led Fisher Black and Robert Merton and others to develop the Black-Scholes model. And this is something that we also see in other historical work on economic models. Marcel Bowman's characterizes economic models as being constructed by essentially fitting together different mathematical and theoretical elements that tend to be drawn from different sources. We also know from some of the other work in the social studies of finance and related areas that different models can become associated with and indeed embedded within different cultures of modeling. So Annette Mikes, Katerina Svetlova, and Christian Hansen have all done really interesting work on these questions. One paper that I draw on quite heavily in this article is by my old colleague Arjen van der Heijden, who has developed a practice-oriented account of model migration that emphasizes the importance of translation to model migration. So when we talk about translation, what this generally refers to is the work that must be done to adapt and operationalize a model, or indeed any other kind of technological artifact, to fit within a particular field or organization. We see really broad empirical support for the idea that when technologies, including models, move across field or organizational boundaries, there usually needs to be a process of translation undertaken to make them fit within that kind of new target domain. So this is kind of an old idea in actor network theory. In ANT, of course, there's a broader notion of translation, the sort of translation of interests that really sort of is quite foundational for the theory. But there's been some empirical work within the kind of ANT tradition that looks at how this process of translation of interests leads to a kind of translation of the physical structuring and operation of objects and technologies. So this is something that John Law has written on, and others. And indeed, there's this tradition in organizational studies as well that has brought ANT's focus on translation to study the kind of diffusion of management concepts and practices. And to some degree, we draw on that in this paper. So we do see growing evidence that models, like other technologies, must be translated to fit within new organizational contexts. But what is less clear is how patterns of model development are shaped by this translation process. So most of the work that's been done to date has really focused on one model or one technology, and has examined how that has become embedded within a new field or a new organization. What we're instead interested in this paper is what are the longer term effects on model development within that new field, say in a particular market, from that translation process. So rather than seeing translation as kind of a one-off process, we're really interested in characterizing this over a longer term period and looking at the impacts of that on the trajectory of model development. Now, in this work, we're trying to bring the literature on translation and model translation into conversation with emerging work that we're seeing on market infrastructures. And as many of you may know, in the social studies of finance in recent years, there's been something of an infrastructural turn in how markets are studied and theorized. So, historically, work in the social studies of finance has really kind of focused on studying particular objects, particular calculative practices or devices, or indeed models. And instead, what we've seen in kind of more recent work is a more holistic focus on the broader socio-technical assemblages or infrastructures into which those particular devices are embedded. So I'll just kind of give a couple of examples of this work here. Juan Pablo Pardaguera's work on the automation of the London Stock Exchange, I think, is a wonderful example of this kind of style of work, as is David Pinzer's recent work as well. And this kind of approach has been applied not just to the study of particular devices, but indeed whole areas of financial infrastructure like payment networks. Now, when we talk about infrastructure, we need to be very careful because, for those of you who don't come from an STS background, in STS, infrastructure has a particular meaning. And so I want to briefly talk about that before moving on. So in this kind of STS characterization of infrastructure, we're really not talking about a kind of specific set of objects like roads or bridges or servers within a data center. Infrastructure is really characterized as a relation between objects and their users. And we can think of objects becoming infrastructuralized when in essence, they become taken for granted and treated as infrastructure by their users. So, the kind of old saying of this within STS, it comes from Susan Starr's work, is that infrastructure is a question of when, not what. So a particular object can be a piece of infrastructure for one set of users, but can be the focus of work for another. Now, one way of thinking about this is to really think of infrastructure as a kind of achievement that occurs when a particular set of objects becomes taken for granted and even invisible to its users. It's functioning well enough that it kind of fades into the background. And connected to this is this property of infrastructure of embeddedness. So we think of infrastructures as kind of sunk into other structures and technologies, including clusters of practices that anchor communities of practice. And conversely, the material durability of infrastructure facilitates the reproduction of those practices across time and space. Now, that kind of brings me to our key research question in this paper, which is, how do models change as they become embedded into market infrastructures? And what lasting effects do these translation pressures that come from that process of embedding, what lasting effects do those have on future model development? Now, in this paper, we examine this question by studying the impact that the diffusion of interest rate term structure models have on model development in the OTC derivatives markets, and in particular, the markets for interest rate derivatives. These models emerged from financial economics in the late 1970s and 1980s, and were gradually translated into the OTC derivatives markets, where, as you'll see, a whole new style of term structure modeling developed within the markets and among researchers connected to those markets. Now, just to kind of fix terminology here, this term interest rate term structure. So what does this mean? This really refers to the relationship between an interest rate and the maturity of a particular fixed income instrument, such as a bond. Interest rate models are used to model future movements of market interest rates. So, as everybody knows, we're now kind of entering this period of high inflation. Interest rates are expected to go up, and part of what interest rate models are used for is forecasting changes in market interest rates. So just to kind of give you a sort of a visual intuition of this, before I really kind of move on to the meat of our argument, this is a plot of the yield curve, which is another kind of way of expressing the interest rate term structure. And this gives the yield to maturity, in effect, the kind of implied return or interest on US dollar treasury bonds over time. And if I kind of step forward in time, this is historical data, but you can kind of see how the yield curve moves. You can see that along some dimensions, it moves quite randomly. There are kind of these shifts up and down. But the structure of movements is not wholly random. And indeed, there are, at least in principle, some arbitrage constraints that prevent the kind of yields on bonds of different maturity from moving too much out of sync. So what term structure models are really used for is modeling the behavior of this particular financial object in a way that's empirically reasonable and satisfies this assumption of no arbitrage. And I think I should just kind of briefly mention that term structure models are used across a number of different financial communities. They're widely used by central banks for forecasting changes in interest rates. They're indeed still used in academic financial economics to address certain research questions. But really, my focus and that of my co-author is on the use of these models in the OTC derivatives markets. Now, in these markets, term structure models are used for three purposes primarily. The first is to qualitatively understand the potential risks that a bank that's structuring derivatives contracts might incur in engaging in that particular transaction. The second is to calculate the fair value or the price of a particular contract. And the third is to produce some information, risk sensitivities, that can be used by a trader to hedge the market risk of each derivative that's held on the dealer's balance sheet. So I think just as kind of additional context, the market for OTC interest rate derivatives, first emerged in 1982 with the emergence of the first interest rate swap deal, and the market grew exponentially throughout the 80s and 90s. And that is really kind of the time period that I'm interested in this paper. The market quieted down quite a bit after the 2008 crisis. And so that's really the time period that we're talking about here. Now, since this is kind of an audience of philosophers and maybe people who are a little bit more technically minded, I wanted to also just give you a brief technical intuition for how these models are used in case that's of interest. So to calculate the fair value of a derivative, what financial mathematicians and quants do is they calculate a kind of discounted expected value of the derivative's future cash flows. And in the case of an interest rate derivative, those future cash flows would be estimated using one of these term structure models. And that kind of discounted expected value can be calculated in a number of different ways. That has some empirical relevance for this paper. One, I think, quite intuitive way of doing that is using a Monte Carlo simulation. So, in the way that I've kind of done here, you can sort of simulate into the future the future payoff of that derivative, discount it back to the present day, and then average those values. And there are other ways of doing this too, using kind of various tricks that come from physics, like the Feynman-Kac formula. This also kind of corresponds to a partial differential equation that can be solved. So there are kind of a number of different ways of doing this, some of which are different numerical infrastructures that can be used for doing this, that can be used for different types of models. And likewise, this kind of process of computing risk sensitivities, this involves a bit more of a brute force calculation. Really what it involves is bumping or kind of creating a slight adjustment to the input to a given model and recalculating the derivative's value. And so if you have a lot of different inputs to a term structure model, those might correspond to different prices. That can mean many recalculations of the model's value, maybe hundreds of revaluations needed per contract. So it is a very materially intensive, very, very computationally intensive process. Now, our argument in this paper is that for these models to really become effective market infrastructure, to kind of complete that transition from the world of financial economics into the markets, to become calculative infrastructure, there were two forms of alignment that these models needed to achieve, really that their developers had to try to balance. The first is what we call ontological alignment. And this really refers to the fact that to be useful to quants and traders and salespeople, term structure models needed to align with the kind of market ontologies that they use to make sense of their day-to-day work, and that were used within these markets. And I'll talk in a second what that means. And the second is what we call material alignment. So as I was kind of indicating on the last slide, to be useful, these models need to make hundreds and hundreds, maybe even thousands of calculations per contract. And that really created an important need for fast computational performance. So as a consequence, it wasn't just these ontological considerations that affected how successful a model was, but also these performance considerations. And these performance considerations, were really quite instrumental in determining whether a model could produce prices and risk sensitivities that were produce those things quickly enough so that this model could kind of become an invisible piece of infrastructure within the markets. Now, what we show is balancing these two dimensions of alignment was extremely difficult from an engineering standpoint. It's not a simple matter that these two things were trade-offs. There were developments that made progress on each of these, but in general, a model that had a very high degree of ontological alignment to the practices and to the objects used by traders and quants often paid a material penalty, and vice versa. And we argue in this paper that this difficulty has really contributed to a diversity of models being used in these markets, with specific models clustered around particular derivatives instruments and to a degree used by particular banks. I'm not going to talk about that too much in my talk right now because there's a shortage of time, but I can definitely talk more about that in the Q&A. But okay, so I want to talk a little bit more conceptually first what I mean by ontological alignment and material alignment. So in terms of this idea of ontological alignment, here we're really drawing on a kind of growing body of work in this tradition of empirical ontology, or the kind of deflationary move towards ontology in philosophy and STS. And I'm sure as many of you know, this really focuses on studying the specific objects, ontologies, the particular communities of practice assume exist. They assume kind of constitute their reality, and we really kind of take that as given. And there, of course, has been some recent work in the social studies of finance that combines this focus on empirical ontology with the study of infrastructure, such as Pinzer's recent paper in Social Studies of Science. Now, what does this ontology consist of? Okay, so this really kind of consists of a set of working objects that quants and traders use in their day-to-day work. And in the interest rate derivatives markets, the three most important sets of working objects are known as forward LIBOR rates, what are known as black implied volatilities, and correlations between these rates. These entities, these working objects, corresponded to prices that were observable in the markets. They corresponded to tradable instruments. And so when traders and quants think about risk management, when they think about structuring a new product, they're usually thinking in terms of these objects, which they can use to hedge and price the instruments that they're structuring. So our first argument in this paper is that there was this trajectory of interest rate model development that really focused on engineering a greater alignment between the mathematical structure of term structure models and the particular working objects used by quants and traders. Now, what did this mean? Well, a kind of simple manifestation of this was that term structure models were gradually re-engineered over time to be written in terms of the working objects used by quants. So forward LIBOR rates, black implied volatilities, and correlations really become core to the mathematical structure of those models. But it really kind of goes beyond that as well. So part of this kind of ontology practice by quants is this underlying assumption that market prices provide the most relevant and important data on the risk of a financial instrument. And that's reinforced by a number of institutional factors such as accounting rules, but among derivatives quants and traders, there is very little focus on using historical data on term structure movements. And instead, what you want to do is calibrate a model so that it aligns very closely with the prices that are currently observed in the market. So that's kind of another dimension of this ontological alignment. And then a third and maybe most interesting form of ontological alignment was the development of term structure models that quite literally reproduced the valuation formula used by traders that make markets in the vanilla instruments that exotic traders use to price and hedge their books. So if you're trading or structuring an exotic derivatives contract and you have to hedge your book using the most common set of instruments were known as caps and swaptions, it was very advantageous to have a model that actually reproduced the same valuation formulae that were used by the kind of upstream traders who make markets in those instruments. And that valuation formula is essentially a variation of the Black-Scholes model. It's slightly different. It comes from a paper that Fisher-Black wrote on the pricing of commodity options, but structurally it's very similar. Okay. Now, as I said, this kind of process of ontological alignment wasn't the only dimension of alignment that we see shaping models over time. There is, secondly, this form of material alignment. Now, models that were kind of well aligned to that ontology were very attractive to practitioners. It was very easy for them to think using these models. They were very intuitive, but quite often these models had severe performance trade-offs, severe performance issues. And that reflects the simple fact that models ultimately have to be implemented on a computer system. A model written purely using mathematical notation is not particularly useful, particularly if you're a trader and you actually need this model to be a calculative device and not just a tool for organizing your thinking, as economists tend to use models. And so these needed to run on a computer system. And if your model wasn't sufficiently performant, that could mean producing price quotations too slowly, which could mean that a client who wanted to buy a particular instrument from you might be waiting on the phone for minutes or dozens of minutes or even longer, and they may take their business elsewhere. So this has a very obvious commercial importance. The ability to produce prices very quickly means more business, and that means that is very attractive to traders and quants. Perhaps even worse, a very slow model could prevent you from hedging your book sufficiently well during a period of high market volatility. And so if your model is not producing risk sensitivities quickly enough, that really becomes a form of infrastructural failure for you. And this last point is a little bit more nuanced, but a number of our interviewees noted that certain numerical infrastructures, so for instance, finite difference techniques, tended to produce better, cleaner, more useful risk sensitivities than other numerical infrastructures, such as Monte Carlo simulation. So this is just kind of a quick quote from one of our interviewees who pointed out, if you can get stuff into finite difference grids, then generally speaking, the risk just comes out crisper, everything is cleaner, there's much less confusion and noise. So for this reason, the ontological dimension is very important, but it really doesn't tell the whole story. And this material dimension also played this very important role in shaping model development within these markets. And in particular, making sure that models were kind of well aligned to the numerical and computational infrastructures that banks were using. Now, having kind of given you our theoretical contribution as I see it, I want to walk you through some examples of this. I'm going to talk about kind of one trajectory of model development beginning in the 1980s and leading up to the mid-2000s. I'll talk about several models and several of the kind of offshoots of these models that were developed to address some of their shortcomings. And what you'll see in these examples is this kind of tension between ontological and material alignment and how these together kind of created this trajectory of model development over time. So to begin this story, we start out in academic financial economics in the late 1970s. And at this time, around this time, this was really kind of the era when there were a lot of path-breaking innovations being made in academic financial economics. Black-Scholes and Morton had recently done their work on options pricing, and there was a real focus on extending that work into new areas. And of course, the way economists use models is quite different from the way traders and quants use models. And I just want to take a few moments to discuss that. So these early term structure models, which really kind of came out of that financial economics tradition, were really developed to address theoretical questions, and in particular questions related to the drivers of the kind of movements in the interest rate term structure, movements in the yield curve. So one academic that I interviewed put it this way. He said, academics care a lot about what's going on with what they call risk premia, and they want to relate those back to the macroeconomy. So the key sort of ontological object for financial economists, especially those who study term structure and the economics of term structure, is what's known as bond risk premia or term premia. And that was very much their focus in developing these models beginning in the 1970s. The empirical work that came out of this tradition focused very much on the statistical analysis of historical bond market data. As we'll see, this is very much in contrast to how quants and traders use these models. And I think a nice way of characterizing this comes from this paper by Yone and Breslau, who pointed out that models tend to be used by economists as a kind of tool for organizing one's thinking about how to explain an empirical phenomenon. And I think Mary Morgan has a nice characterization, a similar characterization in her recent book, The World and the Model, where she really kind of characterizes economic models as being caricatures of real world economic processes. So there are these kind of small worlds or caricatures. There isn't usually so much of a focus on calculation. It's more a tool to organize one's thinking. Now, the first of these no arbitrage term structure models that was developed by somebody named Oldrich Vazicek. Vazicek actually later went into quantitative finance and at one point was pretty involved in credit risk modeling. But in the late 1970s, he developed one of the early no arbitrage term structure models. And it's actually quite a simple model. So what it does, if we go back to that kind of illustration of the yield curve that I had before, Vazicek's model takes a single point on the term structure, this purple point here, and it treats this as something called the short rate. It models the evolution of that single point over time, and it derives a set of prices for bonds that are consistent with the assumption of no arbitrage. So you can kind of model this, this short rate as being driven by this kind of one-dimensional Ornstein-Uhlenbeck process, and derive the prices of bonds and indeed derivatives based on that. Vazicek's model is very simple, it's very parsimonious, and it fits quite nicely with this kind of ontology that was used by financial economists. You know, it's really kind of looking at how different properties of the short rate shape the pricing of bonds, and indeed how what he called the market price of risk, this kind of teal lambda term here, which is a measure of investors' willingness to bear short rate volatility, shapes how bonds are priced in a kind of equilibrium setting. Now, beginning in the 1980s, really at the sort of outset of the interest rate derivatives markets, there was a growing market for what are known as bond options. These were kind of some of the early, at that time, they were seen as exotic products that necessitated the use of new models, say other than Black-Scholes, and banks needed to develop some way of pricing these structures. So quants and traders began experimenting with different models from financial economics, including the Vazicek model, but they soon ran into these difficulties because of the lack of alignment between the mathematical structure of the Vazicek model and the kind of primary focus of market prices in quants and traders' own working ontology. So recall that in the Vazicek model, this model, as I said, really kind of comes out of this tradition of you know, fitting models to historical data, and there's this focus on the market price of risk. Now, to understand how quants and traders use these models, I want to just briefly discuss this quote from a interviewee, a quant, who I call Paul, who I interviewed in 2012, and he explained how term structure models are used. So he said, when you take a book of deals, you first sort of qualitatively examine the risks. What are the risks? Am I at risk of interest rates going up and down? Am I at risk of tilts in the yield curve? Am I at risk for volatilities going up and down? So sort of qualitatively, what are the risks? So once you figure that out, you have to choose a model. And then the second step is always what's known as calibration. And when you calibrate in the interest rate world, you have to do two things. First is you've got to get the discount curve correct. So this is another kind of way of describing the term structure, because you're going to be toast otherwise. The second thing is you typically select a set of vanilla instruments, these swaptions, caps, or floors, things you know moment by moment throughout the day, what their prices are, and you can make sure that your model can reproduce market prices on that calibration set. So if you're a quant and you're using this a term structure model to price something, you have to make sure that your model is capable of matching these existing prices that you see in the market. Now, if you try to do this with a Vasicek model, here's what happens. And this is kind of a little example that I ran using quantlib in Python to just kind of give you an intuition of this. If you try to kind of fit a Vasicek model from historical data and then fit it to today's prices, you get this very bad fit between the two. This maybe isn't so bad if you're interested in trading bonds and seeing what the value of the yield curve should be. But if you're a derivatives trader and you need to take that information as given, as Paul said in the previous quote, it really doesn't work. And so this was kind of summed up by this interview with Emmanuel Derman, who is a notable interest rate quant. He pointed out that, you know, if you took the simple version of Vasicek, you ended up with bond prices that weren't bond prices in the market. The aim was, give me a yield curve, I'll fit it, and then I'll calculate options prices, because it was sort of pointless to calculate the value of an option on a bond when you had already priced the bond incorrectly. Okay, so the first sort of moment of translation that we see in this history is the kind of modification of these early short rate models like Vasicek to fit a visible yield curve in the market. And this was actually a very simple, at least in retrospect, modification. It could be made by just adding a little bit of time dependence to the drift term and the volatility term of the short rate equation. This was something that a number of different financial economists and market practitioners stumbled upon, discovered during the 1980s. I think two of the kind of most famous are John Hull and Alan White, finance academics at the University of Toronto. They publicized this model and developed software tools to calibrate models, variations of the Vasicek to existing market prices, and also commercialized their tools through a startup that was at the time called Renaissance Software. So when you take the model that Hull and White developed and you try to calibrate it to a yield curve and to options prices, you get a much better fit. So there's much, as the way we're thinking about this, there's a much closer alignment to the ontology of rates traders and quants. And this model is actually capable of matching those prices. You can see here that in the case of the yield curve, there's actually a completely exact fit. The two lines are completely overlapping. And if we try to match options prices, it's not an exact fit, but depending on which prices you're trying to calibrate to, you get a fairly good fit. And I'm not a quant, so I'm sure that this performance could be improved significantly more. This is just sort of based on an example using quantlib. So, you know, from Hull and White's work and others, there was initially this tradition of short rate modeling, really that kind of derived from this tradition developed by Vasicek. As I said, the idea was that, you know, movements in the term structure would be driven by this small number of sources of uncertainty, and these models are typically implemented via trees or finite difference methods. These had very nice features. The trees and finite difference methods have this nice feature in that they kind of step backwards through time, which makes them very suitable for pricing certain derivatives that were very popular at the time, such as what are known as Bermudan swaptions, which made up a significant fraction of the interest rate derivatives markets. But they did have certain shortcomings. And one of the shortcomings was the short rate models didn't actually align very closely to how traders and quants thought about the markets. They tended to think of the forward rates and implied volatilities as really being separate entities, because one comes from options prices and one comes from forward contracts or futures contracts. And in a short rate model, those two things were really kind of bound up with one another, which made it very difficult for traders and quants to reason through and about. So the next kind of stage in this development comes from a paper by 3 academics at Cornell University, David Heath, Robert Jarrow, and Andrew Morton, who developed what became known as the Heath-Jarrow-Morton framework. And this paper elucidated the kind of necessary and sufficient conditions that every interest rate model must satisfy to satisfy this assumption of no arbitrage. These models were very different. They modeled the entire interest rate term structure rather than just that short rate. We'll see some of the other properties of this. But one thing I want to emphasize here is that this model is very, very abstract. In the original paper, the HJM model is written in terms of an infinite dimensional stochastic process. It's very difficult to implement in a kind of practical setting on a computer, and that indeed was one of its disadvantages. Just to kind of give you an intuition for what this model is doing, so rather than modeling that kind of single point and deriving a set of no arbitrage bond prices from it, as the Vasicek model does, this model models that whole term structure kind of in one go, and then kind of fits that term structure by default, and then prices derivatives based on that. Now, one of my early interviews pointed out that the real attraction of HJM to quants in the late 1980s and early 1990s was this conceptual alignment more so than its kind of practical features. So this interviewee pointed out, the whole HJM approach was nice conceptually because it had this key understanding of separating out the forward curve from the volatility surface. In short rate modeling, those two were all mixed up together. With the short rate model, the forward curve, it's all mixed up with the volatility surface and mean reversion, it's all tangled. Whereas with HJM, it's much cleaner. You've kind of got the forward curve in one place, you've got the volatility surface in another. And that's nice and intuitive because that corresponds a lot to the way the derivatives are priced in practice. And if you're, so the first thing you ask is, what's the forward? And if you're doing an option, what's the vol? And as soon as two or more things are involved, what's the correlation between them? And you often risk manage those in different ways, and maybe different people are risk managing them. So the ability to separate those things out is very useful. Now, HJM was very conceptually attractive. It had this kind of further ontological alignment with the practices of quants and traders, but it had these real material disadvantages. So as I said, implementing HJM on a computer was far from straightforward. And a bigger issue is that price movements in the HJM framework were actually path dependent. And this meant that all of these numerical infrastructures that banks had adopted and built up to use short rate models really couldn't be used with HJM. And something like Monte Carlo simulation was needed. And at that time, Monte Carlo simulation was very much seen as a kind of last resort that one really didn't want to use unless one had to. So some banks overcame these limitations using technological investments. Interviewees mentioned banks that kind of invested in Cray supercomputers, Sun workstations, and one bank used a very kind of exotic programming language known as APL that's functionally obsolete at this point. And some of these difficulties could be overcome using simple hacks. But another sort of route of development was developing variations of the HJM model that kind of aligned more closely with these material constraints. And indeed, there was the set of restricted HJM models that were developed in the 1990s to solve those issues. But these models also have a number of trade-offs on their own. How am I doing for time? Am I okay?
Yeah, you're okay.
Sorry, what's that?
You can go on, yes.
Oh, okay, great. So that all, of course, is very attractive, but there was actually a really big point of ontological misalignment kind of brewing under the surface. And here's the nature of the issue. Both HJM in its kind of standard form and the Hall-White model, and indeed the Vasicek model, all these models assume that interest rates are normally distributed. So, essentially, if interest rates are kind of close to zero, as they are today, that would suggest that, interest rates could kind of go significantly higher than zero, but also below zero. And that the kind of Gaussian nature of these models made them computationally very performant, very easy to implement. But it obviously had this, well, at the time was seen as an unrealistic assumption that interest rates could be negative. Of course, we know that certainly is the case. We've kind of been living through that for the last, on and off for the last 12 years. At the time, that was seen as very unrealistic. And a bigger issue is that by the mid-1990s, vanilla options traders had adopted a variation of Black-Scholes model to price the instruments that exotic derivatives traders use to manage their books. And this model assumed that these forward LIBOR rates are log normally distributed. So all of a sudden, you have a kind of big ontological misalignment between the practices being used by vanilla options traders and the models being used by exotic derivatives traders. And that was seen as very unappealing. And while there were some short rate models, so kind of models in the tradition of Vasicek that assumed log normal interest rates, they really weren't useful because they didn't produce analytic formulas for the prices of caps and swaptions. So using them was, computationally too expensive in practice. They just really weren't usable. So resolving this kind of ontological incompatibility became a major focus for different research groups. There was a research group in Sydney and one at the University of Bonn in Germany, and a number of different actors, number of different researchers eventually developed what became known as the LIBOR market model, or among quants, it's often known as the BGM model. And this model, by design, assumes that forward LIBOR rates are log normally distributed. So it makes kind of a number of different advances to bring about ontological alignment. First, it's actually modeling forward LIBOR rates, unlike short rate models and the HJM framework, which kind of modeled either the short rate or the instantaneous forward rate in the case of HJM. And what was very appealing is this model could actually exactly match the valuation formulae being used by those vanilla derivatives traders. So this was very appealing to quants and traders because this fit very closely with how they thought about prices in the markets. So if you're an exotic derivatives trader, as I mentioned, you're thinking in terms of forward LIBOR rates, black implied volatilities, and correlations. And this model really fit quite closely with how you understood the market itself. Now, there of course was a downside here. The LIBOR market model came out of that HJM tradition, and so it too must be implemented with Monte Carlo, with all the downsides that entailed. And really until the early 2000s, there wasn't a aside from these kind of simple hacks that I mentioned, there really wasn't a rigorous way to price these very basic callable structures that were very popular in these markets. And so the kind of popularity of the LIBOR market model in turn spurred a new offshoot of low dimensional variants of the LIBOR market model that were kind of compatible with these standard numerical infrastructures. I'm not going to talk about these really too much. They were known as Markov functional models, but in some ways this kind of repeats the pattern that you see about 10 years earlier with HJM, in that you have a model that's very ontologically aligned, but has these material performance downsides. And so there's an effort to create a version that's more performant, even though it sacrifices some of the kind of realism of the original model. Now, so at this point, we really kind of get up to the early and mid 2000s. And the way that I just want to briefly conclude this story is by mentioning that, there really wasn't a clean conclusion to this story. No model has sort of become market standard within these markets, because achieving these two dimensions of alignment in practice has proved so difficult. There was a time when the LIBOR market model looked like it was going to be kind of established as a market standard. If you read textbooks that were written in the early to mid 2000s, they're written in a way that suggests that that was happening. And at that time, there were actually a whole new set of structured products that were being created that became very, very popular among investors. These were kind of structures that allowed one to make bets on whether the yield curve would invert. And they offered a very attractive yield to investors. And so they became very popular. And for all intents and purposes, my understanding is you really needed a model like the LIBOR market model to price these structures in a kind of realistic way. One of the things that happened, though, during the financial crisis is that kind of in the early months of the crisis, there was actually an inversion of that Euro curve. And this forced banks that had structured these contracts to engage in very, very aggressive hedging activity. And one of the things we know from that time, both from kind of write-ups from the trade press, and I've confirmed this with some of my own interviews, is banks that had invested really heavily in the LIBOR market model tended to lose quite a lot of money during this time, because their models were not fast enough to get risk sensitivities out quickly that could be used to hedge their books in an adequate manner. So, this interviewee that I spoke to noted that, people using the LIBOR market model significantly, the subprime crisis would have cost them a fortune, because they couldn't get their risk out fast enough, and it wasn't stable enough to work with. The problem was you had this big heavyweight machinery that took a long time to get numbers out. So again, it was very kind of aligned to the ontology of rates traders and quants, but it did have these material performance downsides. Okay, so I just want to wrap up by kind of going over what I see as our main contribution here. As I said, we build on recent work on model translation to show how the development trajectories of models are shaped when they are embedded within and function as market infrastructures. So one contribution to this paper is, rather than looking at kind of a particular moment of translation, we're interested in the sort of long run development effects of this process of model translation into a particular market infrastructure. And we identified two forms of infrastructural alignment that needed to be satisfied in the interest rate derivatives markets, so that these term structure models could be taken for granted and used as infrastructure, really become embedded into the work practices of traders and quants. And those were alignment to this working ontology of quants and traders. And this ontology, as I noted, shaped their practices and was even reflected in the organizational structure of derivatives trading, and also alignment to the material constraints created by banks' computing infrastructures. As I said, satisfying both of these requirements simultaneously was very difficult. And I think one of the kind of curious effects that it's had on these markets is there really isn't a standard term structure model that's used in the way that kind of the Black-Scholes model became a standard for equity derivatives, and for a time the Gaussian copula became a standard for the credit derivatives. As far as we've been able to tell, there was never a clear market standard like that. You do see models become aligned to particular products, and to some extent, banks developed very kind of idiosyncratic cultures of modeling that prioritize certain models. And I'm happy to talk about that more in the Q&A if you want. All right, thanks a lot. That's it for me.
Thank you very much, Taylor, for your very interesting and stimulating talk. And now we can open the debate. Of course, I have questions, and but if there are other willing to raise questions, they can ask directly in the video. Otherwise, I will break the ice, and I have at least two questions for you. The first one is about the relation between the ontological and the material alignment, in the sense that if I have understood correctly your talk, and the ontological alignment is not a precondition for the material alignment.
Yeah, that's interesting. I don't think it's a precondition. I mean, I think the way that I've told the story, you've tended to have kind of a model that was more ontologically aligned come first, and then there's a kind of variation that's maybe more materially aligned. Is that sort of a lot? Is that logically necessary? I'm not sure. I think to an extent that's sort of how it played out historically, but I don't see any reason why that would be the case. And in fact, I mean, one way you could kind of read this history is the kind of short rate models were very materially advantageous, and then there was kind of a development. There was an effort to develop models that were more sort of ontologically aligned. That's kind of a very bumbling answer to your question. Maybe if that doesn't answer it, maybe you can elaborate.
Yeah, no, in the sense that I was thinking, if the ontological alignment is not a precondition for the material alignment, so my question is, if there are cases where the material alignment can pushes the traders, the practitioners, to ignore or skip some ontological aspect of the model, in the sense that the material alignment can be so important to push us to ignore some ontological alignment.
Oh, I see. Yeah, I think to some degree you certainly see that in the case of if I think back to some of this older work on the Gaussian copula that Donald and I did, you certainly see elements of that in that case. The Gaussian copula, it's a very simple model of credit risk, And it doesn't particularly capture tail risk very well. And so that maybe is a case where the material alignment was maybe overemphasized compared to this kind of ontological alignment for various reasons. And then I think within the markets that I'm looking at here, you're going to see variation across different products to some extent. So, I've kind of divided this into, vanilla instruments and exotic instruments. That is how practitioners tend to talk about these things. That's a very kind of standard categorization. But, some products, some exotic products tend to be more liquid than more commonly traded than others. I mentioned Bermudan swaptions during my talk. Those were very, very frequently traded, especially before the housing crunch in 2007. And so, a quant might be very willing to give up some of that ontological alignment for when pricing a product like that, simply because they had so many of these instruments on their books that they really needed to emphasize the kind of material performance of the model. So I think maybe the way to think about it is, the kind of story that I've told here looks at how these two factors have played out over time, and you do kind of see this this sort of back and forth in the kind of trajectory of model development. But if you're a quant or a trader working in the markets today, or even 10, 15 years ago, you kind of have a menu of options, a menu of different models that you can choose. And each of those will entail different trade-offs between these kind of two dimensions of alignment. So you can have a very performant model like a whole white model. And as I said, you might want to use that to price something like a Bermudan swaption, but you might feel that that's very inappropriate for pricing something that's more illiquid and that has kind of a more complicated risk profile. I think, just kind of something else to mention, that this is sort of jogging my memory. I didn't mention this in my talk, but there was a sort of interesting period of controversy in the historical development of these models, because in the late 1990s, there was a famous paper in financial economics that was published, famous at least in sort of this corner of the markets, where a couple of academics had argued that the kind of the use of models like Hull White and these simpler short rate models for pricing Bermudan swaptions was very dangerous, and in effect, banks were leaving essentially money on the table. I think the name of the paper was something like "Leaving $1 billion on the table." And so the academics argued that this kind of style of modeling, short rate modeling, that really emphasized fast numerical performance was inappropriate for these structures, and they made this argument. But subsequently, a number of quants and practitioners kind of published a response that argued that this actually wasn't the case. I don't know how that debate was ever resolved, but I think that's sort of a good example of how these trade-offs manifest themselves in debates even between academics and practitioners.
Okay, thank you, Taylor. And yeah, if there are no other questions, maybe I have another one. It's about probably something that is implied in the background in your talk, it's performativity. And yeah, my question is whether these two dimensions, ontology and materiality, are those necessary to to produce performativity, in the sense that in order to be performative, a model must be aligned ontologically and materially.
Yeah, so I think to some degree we have to we have to be a little bit careful about what we mean by performativity, and you know, so on the one hand, the way that term is used in some literatures is as a kind of variant of a self-fulfilling prophecy. You know, so a model is performative, you know, if its use actually kind of brings about an alignment between the world of the model and the kind of worlds in which the model is being used. And then, you know, I think maybe there's sort of this more general notion of performativity that simply kind of captures the way that devices and theories and models become embedded within market infrastructure and indeed kind of create the conditions of possibility for new forms of market activity. So I think my answer would differ slightly depending on the kind of notion of performativity that we're talking about. I think in some respects, this case study and what we're kind of drawing from this case challenges this notion of performativity as a self-fulfilling prophecy, because what we really see in the case of these models is they really didn't have this kind of overwhelming agency to sort of remake the interest rate derivatives markets in their own image. You know, they were very, their agency was much more limited, and they had to be adjusted and fit to the local conditions of their use. But I think in terms of this broader notion of performativity, in terms of the way that you know, tools from financial economics become embedded within markets, you know, I think this case study shows how important this process of translation and alignment is for enabling economic theories and models to kind of be used in a commercial setting, or just more generally used in a field outside of economics. I think though it does have some implications for how we talk about this process, because you know, my sense is when people talk about the performativity of economics, it's usually associated with a kind of notion of economic imperialism. You know, this idea that these models are just kind of going out into the world and creating alignment between real world institutions and the assumptions of economics and financial economics. And you know, that if that were true, what we would see in this case is kind of more of a study of model imperialism. What we see here is actually a story of model migration. So these models really kind of migrate into the OTC derivatives markets, and a new style of modeling really kind of emerges that's very different from what financial economists are doing. And indeed, I didn't talk about this, but you know, the researchers who are working on developments in term structure modeling that you know became used in the derivatives markets, they tended not to be economists by training. They tended to be mathematicians, and many of them tended to be within a university setting based in math departments. So I think in that respect, this definitely complicates the picture that we get from performativity about the relationship between the economics discipline and the world that is sort of using these tools that it develops.
Okay, thank you very much, Taylor, again. And
thank you.
And I don't know if there are other questions from the audience, but yeah, I don't see people raising hands, and so maybe, yeah, we could stop here. And I would like to thank you very much again for this very interesting, stimulating talk, and hope to see you very soon back on the Finance Online Seminar in Rome, I hope. And
oh, yes, yeah, absolutely. Okay, thank you very much.